Tim Quast is president and founder of Modernir. Doesn't do a lot of TV, so Tim, we're happy to have you on. And you and I will periodically hit each other on Twitter or text message because we've seen some 1,000 and 2,000 point moves for the Dow lately, and there is a match that lights that fire. But as you and I will talk about, it's the way the market is constructed underneath the hood that will often determine how big and how fast that fire may burn. Is it not? It's that idea of market structure that matters.
Well, it sure is, Brian, and it's good to see you. Thank you very much for the invitation. Yeah, you know, you and I talk about how this is sort of wonky stuff, and I'm happy to be your market structure wonk. But the reason it's important is because the narrative that investors and public companies, you can't forget they rely on the market too, receive determines how they perceive the market. And I think it's important for both constituencies to understand that there are regulations, mechanics, we could call it the plumbing of the market, that is underneath the building that we all fixate on, that plays a very large role in how the market behaves. And sometimes perception and reality don't match. And I think these are the areas where it would be helpful for public companies and investors to have a better understanding of what is, is there real panic or is there not?
And the one thing that we try to show, and there's a reason we do it, let's say we talk about NVIDIA, and we'll often try to show that NVIDIA is in, 500 whatever ETFs. And we do that because, thank you, 800. It's just good information, but more importantly, it matters, I think, Tim, and I think you would agree with this, that when you have a stock that's in 800 ETFs, and then you got derivatives on the ETFs, and you got options on the stock, and derivatives on the options on the stock, that if the company announces something relatively even middle-sized, small-ish, that you could see an outsized move in the markets and that equity because all those things have to adjust at the same time.
You have characterized it exactly correctly.
That's
Brian.
why I get paid the middle bucks, Tim.
That's why you're the host and I'm the guest. But you're exactly right. People don't understand that 90% of market volume is something other than fundamental stock picking. We spend all of our time talking about what is external to the market, which is how businesses perform, when in the market there is this delicate balance. I call it the 1, 2, 3 rule. Under ordinary circumstances, we are in extraordinary circumstances at present, there is a 1, 2, 3 rule that investors should keep in mind. The trackers like SPY, State Street's ETF that tracks the S&P 500, will have ordinary volatility of about 1%. The underlying statistical basket of equities moves 2%, and momentum instruments like derivatives move 3%. And there are machines that calibrate that balance and make sure things don't get too far apart. Well, under what happened in April, one of those things moved and it destabilized the entire structure. And which was it? Well, I would argue we run quantitative data. It was derivatives. And the reason that that's a big deal is derivatives are 20% of market cap.
So, Tim, as we navigate this April that started out with a bang with the Liberation Day announcements, and markets are kind of settling down now here at the end of the month, what does that tell you about what May might bring?
Kelly, nice to see you. Thank you. Well, the way we think about this is there are patterns. There are patterns and periods. We're quantitative data analysts. We're not fundamentalists. We're not technicians. And if you look at patterns of market corrections, they have a symmetry to them. Surprisingly, buying and selling, supply and demand have to equalize before we recover. If we look at the data now and we compare it to the two correction bear market in 2018, one of each, the pandemic correction and recovery, the snapback, the 22 bear market, 2022, and we look at how those patterns are manifesting now, we're not even into the crescendo. Now, I don't know what's going to happen. Every time somebody tries to prognosticate about the market, they're rendered a fool. But I look at those patterns and say, we have a substantial period of time to go. And there's a touch point even this week that people should think about. On April 30, last day of the trading month of every month, a major basket of index options expires. Then that's going to be coupled with GDP and PCE, same day. I'm not saying that day will be volatile, but if suddenly the market becomes volatile again, we should think about the fact that we have a long way to go probably to get through this pattern, and we're going to have touch points like that.